Well, good afternoon, everyone, and welcome. I'm Chris Karam, Chief Investment Officer at Finspire. We're thrilled you're joining us today. For decades, 401k participants have had access to only a single sleeve of the investable universe known as the public markets. But as we all know, the world is changing. Private markets now represent over half of the global investable universe, and the question facing plan sponsors, committees, advisors, consultants is whether private investments belong and not only belong in retirement plans, but if so, how do we do it responsibly and effectively integrate them into what has been heretofore a public markets investable universe? So today's session is designed to cut through a lot of the noise that you may or may not have been hearing about private markets investing in 401k plans. We'll walk through the regulatory landscape, the operational considerations, and most importantly, the practical models emerging to bring institutional grade private market access to everyday retirement savers. Our goal is simple: it's to equip you with clarity, confidence, and a framework upon which you can take action. So I'm not doing this alone today. I'm joined today by experts and professionals from State Street Investment Management and Apollo Global Management to help guide us through all of this noise and bring clarity to you. We will begin with Melissa Kahn and James Ryder from State Street Investment Management. We'll pivot over to Norb Kong and Neil Loftus joining us from Apollo Global Management and share our perspective on how we're guiding plan sponsors through this complex topic in the first place. So, panel, welcome. Glad you're joining us today to work through this interesting topic of investing in private markets and 401k plans. Before we proceed, I would just like to share a brief introduction for those of you who don't know about Finspire or know too much about us at Finspire. We're a mid-sized, independent, multidisciplinary investment advisory consulting firm located in the Chicagoland area. We advise plan sponsors and individual investors. And within our plan sponsor business, we specialize in serving private equity firms and other acquisitive organizations with retirement plan mergers and acquisitions consulting during that critical pre-acquisition due diligence phase. Our vision as a firm is to be the most indispensable investment advisory and consulting firm in the country. And today we are supporting that vision to bring leading edge content directly to you. So let's get to the hot topic of private markets and 401k plans in this very frigid winter blast that we're all experiencing, or most of the country is experiencing so far. So Melissa, I'd like to start with you because you have all the info about why we're here today in the first place. You are the all things Washington, D.C. expert, is what I like to call it, for State Street Investment Management. There was, of course, a presidential executive order that dealt with private markets and 401k plans. We'd love to hear about what the purpose of that executive order was and what the key directives were in that order.
Terrific. Well, first of all, thank you, Chris, and the Finspire team for inviting me to be part of this. Just to give you a little bit more background about me, I do work on our retirement team at State Street Investment Management. So James Ryder and I work very closely together, and I do public policy work for the team. So I'm in Washington a lot, dealing with Capitol Hill and with regulators, including the Department of Labor. With regard to the executive order, as we know, it was issued back in August, and we were pleased to see it. I think there was a recognition at the White House and in the administration generally that we have to expand opportunities, as they like to say in the executive order, democratize investing for more people. And how best to do that? Well, most people who work for employers have access to a 401k plan. And today, as we know, and James may get to this, sort of the investable universe of public companies has shrunk, while the investable universe of private companies has grown dramatically over the last few decades. And so I think this is a way, in a responsible way, to increase the opportunities for retirement security. And I think that's what the executive order was really trying to get at. One thing that we were really thrilled to see in the executive order was they really did call out this litigation environment that we are seeing today. Plan sponsors, no matter what they do, whether they're have plain vanilla investments, whether they have innovation in their plans, no matter what they're doing it wrong. And so the executive order really called that out. The other thing I think that we were pleased to see is they direct the Department of Labor to really be the bearer of the guidance that they want to see in this area, but they did direct them to work with the Securities and Exchange Commission and the Treasury Department so that there's going to be consistency among all the federal regulators in this space when it comes to including private markets in defined contribution plans. So we were very excited about it. They gave the Department of Labor 180 days to come out with guidance. So that's where we were with the executive order.
And about that guidance, Melissa, rumor has it that we may be seeing something from the DOL as early as next week. Could you give us any insights into what you think will be produced out of that guidance? But also, could you talk a little bit more about the potential challenges that the Department of Labor working with the SEC on a matter like this, some of the challenges that arise from, especially as it relates to private markets investing specifically?
Yeah, great questions. So I'm going to give you my crystal ball. Don't take it to the bank yet. If they meet that 180-day time period, that means they will have something out actually next Tuesday, a week from today, February 3rd. Crazy, right? I know they've been very, very diligently working on this, through the government shutdown, through the holidays, everything. And as everybody probably knows, the proposed regulation is now at the Office of Management and Budget. Technically, the Office of Management and Budget has up to 90 days to review it. My understanding is that they are in an expedited timeline, that the White House is really pushing for them to meet that February 3rd or as close to February 3rd deadline as they can. So now that it's at OMB, to your second question, Chris, there is coordination. So the Treasury Department, the Pension Benefit Guaranty Corporation, the IRS, the SEC are all looking at the regulation so that they can marry, because the SEC obviously is much more focused on retail investors, a little bit less so in retirement plans, but there will be very close collaboration so that when the rule comes out, the SEC will have had input into it and hopefully will be coordinating whatever rules that they come out with to sort of match what the Department of Labor is doing. A couple of things I will say. My guess is that the text of the reg itself will call for asset neutrality. So what does that mean? It means that per se, a plan sponsor fiduciary would not either be prohibited or required to invest or offer investments in any particular asset class. So it's going to be, I believe, the text itself will be pretty plain vanilla and go to that heart. What we're going to be most interested in and what everybody will be reading closely is the preamble. I think that's really where they're going to attack all of the questions that have come up and the concerns about private equity and private real estate and private credit, alternative assets in general. And that will include, well, how do you value these? What's the liquidity concerns? What are the fee concerns? And I'm hoping that this guidance will also go to the heart of litigation risk. So in other words, if a plan fiduciary does X, Y, and Z in its process, that it should be insulated from lawsuits. So that's sort of what we're looking for. My belief is that we will have a 60-day comment period in which to get our comments in, and then it will be subject to review, and the Department of Labor will have to address all of those comments in some way. So if I had to guess, I would say we're going to see a final regulation no sooner than late spring, early summer, and my guess is it may even go into the fall.
Okay, good. So still some legwork on the regulatory / fiduciary front to come before some of the guidance is offered up by the DOL to plan sponsors.
Absolutely. And I would say to you, Chris, to your firm, to any of your clients that are concerned or interested in including some sort of private markets, put a comment letter in because they need to hear from us, whether we support it, whether we have concerns with any part of it. I know that our firm will be commenting on the rule and many others in our industry.
Got it. Thank you so much. Yeah.
Welcome.
So let's pivot to your colleague, James Ryder here. James, you're the portfolio architect, I call it, for the State Street target date solutions. You're primarily known as a very large passive investment shop. So why now private markets? What led you to incorporating private investments into your target date suite, knowing that private markets, just as Melissa mentioned, whether you're in the pension business, the foundation, these aren't new investments by any stretch. There's just now this new pool of participants and assets and programs to be that private markets now are potentially being a part of in the defined contribution 401k space. Tell us about that, about your foray into private investing in target date investments.
Thanks, Chris, and thanks for the opportunity to be here. Don't love following Melissa because it's a tough act to follow, but I'll do my best. You've got it exactly right. When anybody thinks about State Street Investment Management, they think of us as a traditional asset manager. We manage $5.7 trillion in assets globally, and that's across different client types and geographies. A little over $1 trillion in DC assets. Much of that is in our target date strategies, but the lion's share of that is in low-cost, index-based implementation. And specific to target date funds, we've been managing target date funds for close to 30 years now. And a key tenet of our approach has always been to evolve the asset allocation, to evolve the opportunity set as market structure evolves. So when we think about that in a simple sense with public markets, when we first launched our commingled target date funds 20 years ago, you could build a broadly diversified target date fund just holding your plain vanilla public market exposures. There weren't that many other options. But over time, as asset classes have become more available, as they become more investable, think high yield, commodities, real estate investment trusts, couldn't really replicate these passively 20 years ago. You can now. We've added more asset classes to our opportunity set with a goal of building more efficient portfolios. And when we consider asset classes for inclusion, and I appreciate the slides being brought up here, there's really three key criteria that we look at. The first is desirability. So this is the investment case. This is the quantitative considerations, the risk, return, the correlations. The second is investability. So can we implement that investment theme effectively? And the third, which is a bit more of a catch-all, is suitability. So is the asset class appropriate for the nuances of the defined contribution ecosystem?
Right.
And when we think about private markets in this construct, I think it's a really helpful framework to apply because the desirability case has always really been there, right? You can quibble about manager selection, you can quibble about the specifics of asset classes, but if you don't believe that there is some potential to improve risk-adjusted returns by pairing public and private markets and potentially improving outcomes, then the conversation really stops here. But I think it's fair to say that there is that opportunity. It's really the investability and the suitability, so the latter two, that have improved dramatically in the last few years, which has taken that kind of in the lab idea and brought it more into a realistic case for implementation. So as we look at the next slide, there are some key kind of attributes of market structure that Melissa mentioned, and I won't belabor, but I think are important to highlight. And one is that private markets have grown dramatically as a percentage of that overall investment opportunity set. So what we're showing in the chart here is private equity and private credit growing 3 and 4x as a percentage of the investable market over the last 20 years. We do our own work in this regard. We take alternatives broadly. About 6% of the global market portfolio is in alternatives 20 years ago. It's close to 15% today. But actually, when you look at it as a percentage of total companies, then that relationship flips. The number of non-listed companies or the number of private companies relative to public companies dramatically higher. And when you think about a shrinking opportunity set in public markets, increasingly correlated public markets, and these well-known trends with companies staying private for longer, that really has a profound impact on both public and private markets alike. So all of this goes to say that considering private markets in that broader asset allocation framework is something that we think is incredibly important and will be increasingly important over time. The last thing that I would highlight on this, Chris, as we think about that journey towards private markets is really that evolution in structure. So when we look on the next slide, I think it's important to take a step back and just highlight quickly, when we talk about incorporating private markets into retirement plans, what specifically are we talking about here? We're not talking about standalone investment options where a plan participant can take all of their money, allocate to a potentially illiquid private market vehicle. What we're talking about is allocating a small allocation to private markets within a multi-asset professionally managed solution. The best fit for this, in our view, is the target date fund. The reason for that is target date funds are used by the vast majority of plan participants. So 83% of plan participants use target date funds. Very, very few participants actually trade their target date funds. So when we compare the percentage of participants that trade in a retirement plan in any given year for those do-it-myself investors who are using the core menu to build their own investment portfolios versus target date investors, it's dramatically lower year over year when we look at those target date investors trading. So long-term buy and hold type investors. But even then, the historical framework and the historical structure of private market vehicles was not particularly compatible with the defined contribution ecosystem. When we think of ourselves as a target date manager, we still need to rebalance these portfolios. We still need to be able to facilitate plan level redemptions. And the traditional drawdown structure of private market vehicles, where you have an upfront commitment, you're locked up for a potentially long period of time, ongoing capital calls, J-curve, none of these things work particularly well with the needs that we have to manage those liquidity needs. So it's really been the emergence of these evergreen vehicles. So semi-liquid perpetual fund offerings that are designed to provide that ongoing liquidity tend to be a little bit more focused on ongoing cash flow. We've got here that's a $350 billion market. By last check, that had grown to 500 billion, so a rapidly growing market. It gave us a much broader universe of funds that fit a little bit better into that target date framework to choose from. And that really allowed us to think a little bit harder about how to incorporate that in the target date framework.
Yeah, so the first iteration, most likely, of investing, having, say, a defined contribution 401k participant actually invest in private markets, is going to be through a professionally managed asset allocation portfolio already, right? So whether it's through a target date suite as you've constructed it, or in some sort of professionally managed account where there isn't any direct input per se from a participant other than their profile or their investor profile, right? It's important for people to know that that's the first iteration of this, which could mature later on into standalone access to a private markets portfolio where a 401k participant can choose how much to allocate in this area. But that's really what the first iteration of this is going to likely look like, is in some form of professionally managed allocation or professionally managed portfolio. And then it's also not just for private equity, but you're seeing the area where debt also. So you can see concepts of the equity side of the equation, the debt side of the equation also being addressed, and real estate potentially also being addressed in the private markets as part of these investment pools. So along this journey, you decided to partner with Apollo Global Management. Walk us through that journey and what I think you gave us a sense here of generally what you were seeking in a private markets partner, but walk us through that general due diligence that you went through at State Street to say, look, Apollo is a right partner for us at this moment for this purpose.
Yeah, and it was truthfully years of work that led to that decision, Chris. And I think that it starts with what we were trying to accomplish, and then I'll get into some of the risks that we had to consider, and really any investment decision maker has to consider. So on the next slide, we're just laying out what was most important to us when we thought about incorporating private markets into a target date fund. Sorry, prior slide. Apologies. There it is. Thank you. So the first thing that we were thinking about from an investment perspective is we wanted broad exposure to private markets. You mentioned it, Chris. It's not just private equity, which is a great source of long-term return. You also have asset classes like private credit, private real assets, which tend to be a little bit more cash flow generating. So there's unique characteristics to each asset class, and there's unique potential value add to each asset class. but there's also potential for idiosyncratic risk. There's also potential for cyclicality that comes with each. So when we dug into what we were looking to accomplish in a broader target date glide path, we preferred a multi-asset approach, both from a diversification perspective, but also as a means to manage some of those idiosyncratic risk. That said, there will be different approaches to this question, right? There's a number of different ways to look at this, but purely from an investment standpoint, we really valued that diversification, that potential volatility reduction of a multi-asset approach. The second really important consideration for us, because we are a defined contribution team, we're focused on the defined contribution world every day, is that investability equation. And we highly valued a private market strategy with scale. When we think about the liquidity that we need to rebalance that portfolio on an ongoing basis to give plan sponsors some level of comfort that plan level redemptions can be facilitated, the scale of the portfolio is tremendously important because that impacts the amount of ongoing liquidity that you expect to have access to. And obviously market conditions will impact that. But when you think about the scale of the portfolio and then characteristics like the diversification and the underlying cash flow, that's very important in that liquidity profile and really helped us get comfortable with the ultimate strategy that we chose to allocate to. And then another thing that was important to us is this is all going to be new to a lot of defined contribution plans. We valued a private market strategy with a track record. So when you think about building something bespoke for a new market, the idea of scaling up, in those early days from a liquidity perspective was something that was a little bit worrisome from our perspective. So we really were focused on a strategy that already had that track record, already had that scale. The last thing that I would focus on is we really wanted to make sure that if we were doing this, if we were going through the operational work, we wanted to make sure it was meaningful. So the ability to establish what we viewed as an allocation that would have a meaningful impact on that end participant outcome throughout participants' careers was incredibly important. And the things that I just mentioned, the scale, the diversification, obviously impact how comfortable we were with that allocation. So
that's right. You don't just want to have a token allocation, right? And say, well, this is what it's going to be, and you want to make a meaningful impact on total return, or total returns or risk-adjusted returns as well.
Exactly. And as I said, there's different use cases for these asset classes, whether you're looking for diversification, whether you're looking for return, but you do want to make sure that exposure is meaningful enough to impact the end outcome, while also very mindful and very focused on that liquidity side of the equation. So actually, I think that's a good segue into what we would view as the most common concerns associated with incorporating private markets in retirement plans broadly, but also in multi-asset strategies like target date funds. The first is obviously liquidity. The number one point that I would make here is you do need to separate what liquidity means to different people. So there's plan level liquidity, which is the ability to change managers to make those plan level changes. But there's also participant liquidity. And it is table stakes in the defined contribution world where participants have to be able to trade in and out of their target date fund on a daily basis. Yeah. So we would argue that the structure of the target date fund really helps support that participant liquidity in that a small allocation to private markets implies a very large allocation to public. And you can use those public markets to facilitate that participant level trading on a day in and day out basis. Where the liquidity profile of the private markets manager really matters is when you're getting into that rebalancing, those larger events like plan level redemptions. The second question is around valuation. So one important industry innovation, if you will, is wrapping private market strategies in collective investment trusts. Collective investment trusts allow for a daily net asset value to be struck, but the valuation processes of the underlying private market manager are incredibly important. Are those processes robust? Is there independent oversight? Do you have assurance and belief that you're transacting based on best available information on an ongoing basis? And then the third, I can't believe we've made it, 25 minutes at this point without talking about fees and defined contribution. It's probably the longest we've ever gone in the meeting. But fees are incredibly important to defined contribution plan sponsors. So there is a well-established framework for fee evaluation in target date world and DC plans more broadly. But you have to be competitive from a fee perspective, and you also have to be transparent. We recognize that private market fee structures are very different than public market fee structures. Benchmarking is not going to be apples to apples, but that level of transparency, what goes into that fee, what is that all-in expense ratio, that's incredibly important to be able to articulate. So maybe just quickly, Chris, the last thing I just wanted to show, this is a 30,000-foot view of what an allocation to private markets might look like in a target date strategy. I'm not really getting into the specifics here on the next slide, but what I did want to show is we are talking about a small, you could call it modest, but an allocation to private markets within an otherwise broadly diversified multi-asset public market portfolio. We're not talking about taking 75, 80, 90% of a participant's balance and putting it in private market strategies. But we do believe that that incorporation in a professionally managed portfolio can be additive from an outcome perspective. Just have to be very, very thoughtful about those considerations around liquidity and valuation and fees.
Nice. Yeah, I know that the concept of liquidity evaluation fees are going to be top of mind with a lot of our clients, a lot of our plan sponsor clients, and how this fits into what they have currently. But yeah, when you can place it into an elegant situation like this, like a professionally managed asset allocation solution, such as a target date suite, it certainly can address a lot of those, knowing that there's a lot of liquidity throughout the portfolio, throughout the broader portfolio. And of course, I agree with you. I don't think I think it's been years since it's taken as much as 25 minutes to get to the topic of fees when it comes to actually articulating a value of the portfolio. So I'm going to switch over to Norb Kong. Norb is with Apollo Global Management. Now, Norb, now that we know that State Street chose Apollo as a key partner, give us an overview of your role, Norb, and how Apollo views the defined contribution space in general.
Sure. Thanks for the question, Chris, and happy to. By way of introduction, so I am the defined contribution specialist here at Apollo. I've been in the DC industry for almost 10 years. First part of my career was with a large asset manager on their DCIO team. And then the last 4 to 5 years, I was with a pure play private market manager focused on private wealth, but also specifically focused on trying to figure out how to navigate the DC market inside an internal working group. So what I could say is I've been having these conversations as early as 2021. And what's happening today is pretty profound because a lot of the conversations are no longer philosophical or theoretical. They're turning into actionable items. So as a DC specialist here at Apollo, I'm working with plan fiduciaries, plan intermediaries, on how to think about implementing private markets across their DC practice. So for those of you less familiar with Apollo, Apollo is one of the largest asset managers in private markets globally. We've been catering and serving the retirement market for decades historically. That's been through our relationships and partnerships through DB plans, but also on the insurance side. Our insurance arm, Athene, has historically had a longstanding commitment to delivering retirement income for retirees. So with that in mind and that background, that's really shaped how Apollo has thought about long-term capital, essentially, downside protection, but also delivering strong alpha and delivering portfolio construction across market cycles. Now, when it comes to our perspective on the DC side, when it comes to the inclusion of private markets, it really starts with a simple reality. And that simple reality is private markets, for most of its history, has not been structurally compatible with DC plans, right? So when you think about access, this is somewhat echoing what James highlighted earlier. But when you think about access, private markets traditionally came through traditional closed-end drawdown vehicles that had these long lockup periods, capital calls, J-curves, limited liquidity, and episodic fundraising. And those structures, as you all know, work pretty well for DB plans, sovereign wealth funds, but they don't work well for DC plans that can't lock up capital for long periods of time because they have to account for benefit responsiveness. And so 2 structural changes had to occur for private markets to be feasible within the DC space. The first structural change was within private markets themselves. So over the last decade, really, you've seen firms like Apollo spearhead a lot of the development around evergreen private market structures. These structures allow for periodic subscriptions, immediate deployment, essentially with no J-curve. So capital is put to work almost immediately. Built-in diversification, regular valuations, and periodic liquidity. So just more feasible structures that allow for broader access while maintaining institutional quality investing. And then the second change came within the DC ecosystem, and you guys have seen it over the last decade. DC plans today are increasingly professionally managed, where you see participants investing through target date funds, managed accounts, and other advisor or managed solutions. And so that shift, when you think about it, it really mirrors what you see on the DB side, which is essentially a natural framework for incorporating private markets, right? Historically, private markets have always been available on the DB side, kind of going back to my earlier comments around our work on the DB side. So Apollo's approach to the DC space has therefore been deliberate and collaborative with partners like State Street. We do not believe private markets belong as a standalone participant elected option on a core lineup. We do not want participants electing on their own. Instead, we believe they belong embedded within professionally managed solutions where liquidity, valuation, and fiduciary oversight could be addressed holistically. Practically, that means using semi-liquid evergreen strategies as the investment building blocks, delivering them through DC appropriate vehicles like collective investment trust or CITs, and tailoring each structure based on the specific use case, whether that's advisor managed account or another professionally managed solution, but specifically like a target date fund like we have with State Street. That philosophy is exactly why Apollo and State Street chose to work together. State Street's index plus target date strategy combines, as James alluded to, low-cost index public market exposure with a thoughtfully sized allocation to private markets. Apollo providing the private market sleeve, while State Street retains full control of the glide path and participant experience. And ultimately, Apollo contributes differentiated private market exposure in a way that integrates seamlessly into a DC framework. So those are our overall views. I always like to, cap off my remarks when it comes to these conversations by saying this has always been here. The plumbing just needed to change to make it more feasible on the DC side.
It's a great point, Nora, because for what you're touching on today is something we can't expand too far into today, because I think there's probably like a 2.0 version of this discussion, because you touched on things that, hey, although the investment strategies may have been around a long time, the method and the technologies that are required to actually translate everything we're talking about today into a daily price or into some sort of valuation to a defined contribution 401k participant, there's a lot there. And
Exactly.
And probably something there that we'll have to do in a round two of a discussion. So to your colleague Neil Loftus, who's also joining us from Apollo Global Management, you got to have a strategy that fits, Neil. So describe a little bit at a high level what Apollo's done or is planning to do structurally to develop a strategy that fits within all of this defined contribution construct and all these parameters that we have in our industry.
Thank you, Chris. Happy to. And by way of brief introduction, again, my name is Neil Loftus. I lead client coverage for Apollo's Midwest Wealth team. And I tend to focus on working with large RIAs and multifamily offices predominantly. I cover the entire platform. And in my role, there's both a lot of thematic and client overlap between private wealth and the retirement space. So Norb and I work side by side wherever applicable, this conversation being a perfect example. So Chris, the strategy you referenced is designed to provide access to Apollo's flagship private markets portfolio in an evergreen format that is a semi-liquid structure. This portfolio was originally built for our own balance sheet. To Norb's comments, this has always been here. And we've executed this strategy for over 10 years now with a goal of generating equity-like returns with lower volatility, greater downside protection relative to both public equities and more traditional private equity. I think it's important to note that very little of the portfolio is allocated to traditional private equity or buyout risk. As some of the slides previously shown reference, this is a multi-asset portfolio primarily focused on ownership of businesses that generate strong free cash flow, tend to have very modest leverage profiles, and often these are businesses that we want to own essentially in perpetuity. We like to say, think of this as equity that is private versus traditional private equity for the most part. Now, it will deploy through a relative value lens, meaning we can allocate across private market asset classes depending on where our team is finding attractive risk return. And really, the focus here is on providing consistent and persistent returns with less correlation to traditional indices versus simply trying to achieve the highest absolute rate of return. Again, I want to draw some material differences between traditional private equity, which I know many of the folks on the line are familiar with. Ultimately, I do want to highlight again that this is a strategy that has certainly achieved scale. It's $25 billion and growing. It's very diversified, and there's a strong emphasis on both shared outcome and alignment from the Apollo side of the equation. You know, as this is a balance sheet investment for us, our capital represents north of $13 billion of this $25 billion pool now. So I hope my comments can just help tie together the history of the relationship between State Street and Apollo, why we have taken this approach to private markets dating back long before the thought of being a part of the retirement or defined contribution space was a reality. And certainly thanks so much, Chris, for the opportunity for us to participate today.
Yeah, you bet. I mean, there too, just like Norb did, gave us a lot to chew on for potentially a 2.0 there, which is, well, what's inside these vehicles and how traditional or non-traditional is it in its approach when inside of, say, an evergreen style portfolio or a strategy that could fit well within a professionally managed account structure. Well, thanks, Neil. Yeah, we're tying this all together. We at Finspire, we're in the business of providing investment advice to plan sponsors, to individuals. We have the responsibility to review this new opportunity and inform our clients whether it's appropriate and not just whether it's appropriate, but then how to. So we do a lot of education with our clients, given this new opportunity. It just so happens that one of the big items that we review the first quarter of every year with our plan sponsor clients is their investment policy statement. Okay, especially as it relates to their defined contribution plans. Well, given this new opportunity, there are a lot of things that we're guiding clients through and advising them about this particular topic of investing in private markets and 401k plans. Does the policy statement need to be amended? Should it be restated? Sometimes track record needs to be defined differently in an investment policy statement if you have that verbiage inside your policy statement, because a lot of what's coming to the market is packaged in a way where the track record is not perhaps in the product that is coming to the market, but it's in a historical figure from a previous arrangement. So how do you account for that as a plan sponsor? Look, as we know, investing privately is a large investable universe, can have a significant impact on performance or risk-adjusted returns. So we're going to treat this a lot like we did with the concept of retirement income, right? We're not new to advising and guiding plan sponsors on complex vehicles and concepts such as retirement income, and we think private markets fit in this same realm, where it's going to require some education. It's going to require an examination of the investment policy statement, and then being able to introduce certain strategies that may make sense for plan sponsors, 401k participants. But I'll add this. The industry, and this again was spurred by Melissa's comments earlier, that, okay, it's not the presidential executive order doesn't say you have to invest in private markets. It says that you can give them a fair look as a fiduciary on the merits of incorporating something like this to offer to your plan participants. It's worth noting, especially and I speaking on behalf of a lot of plan sponsors out there in the universe, especially in the US, they're just digesting Secure 1.0 and 2.0 into their plan and into whether it's plan documents, whether they're operational functions, payroll, et cetera. It just goes to show you that retirement plans are getting more complex. And so that's one of the areas that we certainly aim to help our private equity firm clients with, is saying, given this extra layer of plan level complexity of introducing private markets on top of Secure 1.0 and 2.0, how are you handling this, especially in that pre-acquisition due diligence phase? What are you looking out for in those retirement plan due diligence projects to say, okay, we need to accept this, avoid this, incorporate this with our existing portfolio companies' plans or not? And so that's all part of what we do as well on that important pre-acquisition due diligence phase. So I just want to say thank you all for joining us today. I think you learned that private markets are no longer, in 401k plans, it's no longer a theoretical, but a real actionable opportunity for plan sponsors seeking how they might build more resilient, diversified portfolios, trying to improve performance, risk-adjusted returns for people of all ages, right? And that's the purpose. What we talked a lot about today was target date strategies that incorporates that from when you're entering the workforce to all the way through retirement. So as you reflect on today's discussion, just want to let you know that our team here at Finspire is here to help you evaluate all of this, the feasibility, the available structures, the policy statements, and help build you a roadmap that aligns with your individual fiduciary responsibilities. At the end of the day, we think this is an inflection point in retirement plan investing. It's not happening overnight. There's been a lot of years of build in the making here. And we, as you know, we still have more information to follow from the government, as well as into products and solutions that are coming to the market to help you along the way. If you have any questions or want to explore this further, please don't hesitate to reach out. Thanks again and enjoy the rest of your day. Thanks for joining us, and we'll talk to you real soon.